Good morning, everyone. Welcome. I am Ernesto Burden. I'm the publisher of New Hampshire Business Review, and it's my pleasure to welcome you to today's New Hampshire Business Review webinar, Navigating Market Volatility and Strategies for Financial Stability. Today's webinar is presented by Rise Private Wealth Management. Thank you to them for sponsoring. And today we'll be hearing from Geery, private wealth advisor and certified financial planner from Rise Private Wealth Management, and Nick Trombetta, Director of Investments for Rise Private Wealth Management. So I am going to step aside today and let Katie and Nick take it away. Just a reminder for the audience, they will be taking questions at the end, and you will be able to type those questions into the Q&A feature here on the webinar platform. So please do add questions as we go along. And welcome, Katie and Nick.
Thank you, Ernesto. Good morning, everyone. As Ernesto said, I'm Katie Geery, and we're so looking forward to sharing some of this timely information with you all. I wanted to start by just sharing a little bit about Rise and who we are to set the sort of framework, and then I'm going to pass it to Nick to talk a lot about what's going on in the markets and the investment strategy there. So Rise Private Wealth Management, we're headquartered here in Bedford, New Hampshire. If you're familiar where the Target and Lowe's are, we're right over the hill from there. Although we're headquartered in New Hampshire, we're a national company. We have 35 advisors on the team, but nearly 100 people who work for our Rise team, which is amazing. Our location in New Hampshire is in Bedford. We also have a location in Littleton, New Hampshire. In addition to that, we have offices in Maine, New York, Kansas, and Florida, and work with clients all over the country. Our mission statement here at Rise is to provide financial advice that provides confidence, simplicity, and success. And so our goal for the webinar today is to give you a little bit more confidence, to simplify some of the noise that's happening here in the markets today, and hopefully help set you up on a path for success to reach your financial goals and continue to feel confident doing so. So without further ado, I'm going to pass it over to Nick to talk a little bit about what's going on in the markets. And again, to mirror what Ernesto said, please ask questions in the Q&A box because we want to have some time for Q&A to get your questions answered today. Thanks so much.
Awesome. Thanks, Katie. Can you see my slides okay on your side? All right, perfect.
Sure can.
All right, so today we'll talk a little bit about what volatility is. We'll dive into some current events and what's actually causing that volatility. This call is very timely that we happen to find ourselves in some pretty volatility, so we'll have some fun stuff to talk about there. Then we'll tie that into some, actual investment complications, how that affects portfolios, and then how we build portfolios to protect ourselves and take advantage of these situations. Then Katie will talk a little bit more about our planning process and how we help you reach your goals and how the investments help you get there. So that will start with the volatility piece. So volatility, there's a technical definition. I think some people will use standard deviation or variance to mean volatility. There's also an index. If anyone's ever heard of the VIX index, there are ways of measuring volatility. Essentially, volatility is just how much prices are bouncing around, usually bouncing around an average. So, if we say that the average annual return for the S&P 500, for example, is 10%, some years it's up 25%, like last year. Right now it's down probably 17%. Other years it can be up even more than that or down. So we would say that's highly volatile, right? If you look at something like the bond market, for example, say on average that's up maybe 5%, sometimes as high as 7%, maybe sometimes as low as 3%. That's a lot less volatile, right? It doesn't move around that average as much. So volatility is just really how much prices can move up or down around their average expectations. However, with those technical definitions, really what we focus on and the times we hear about volatility the most are when we hear downside volatility, which is where we find ourselves today, right? Markets selling off, things are going down, in a correction, in a bear market, right? So this sort of negative volatility is really when you hear most about volatility, and really when you hear about it in the news or you read about it in the paper, this type of volatility is really what people are referring to. So now we can talk a little bit about what causes it, and specifically what's going on in the market today. So if we take a step back, it's been very volatile this week and very volatile last week, but really volatility really started around February 20th, February 19th. The market peaked on February 19th of this year, and started a slow decline and then a more drastic decline last week. This really started with the tariffs coming out of the new administration. Originally, this was focused on Canada and Mexico. Then there were some specific tariffs based on different products. So that caused a little bit of volatility. This was a little bit unexpected. Market got a little nervous. And then last week we saw retaliatory tariffs, which were broad. We saw a 10% tariff across the board, as well as some specific tariffs on different individual countries. They used a formula for this. They were really looking at trade deficits. So they're, trade the tariffs were much higher than expected. And that's a key point. We'll talk about that in a minute. But there were also a few things that were omitted, which is silver lining, I guess. Anything covered in the United States-Mexico Canada agreement was exempt from the tariffs that were announced last week. That's good news, as well as some key goods like aluminum, steel, autos, pharmaceuticals, semiconductors, copper, lumber, right? So those things were left out of that as well. So it's kind of silver lining, some good news. Who knows, there could be some changes to that, but as of right now, that looks good. Now, these tariffs were surprising. They're the largest tariffs we've seen implemented in non-war times. So it's very difficult to predict what's going to happen. So there's created a lot of uncertainty. Markets don't like uncertainty. And they were surprised, right? There was a prediction. We talked about it in some calls earlier this year. Everyone's been making predictions of what they think will happen as a result of tariffs. Tariffs themselves, the word tariff was telegraphed pretty well by the administration, but no one expected them to be as severe as they were. So very surprising. The reason why this is key, when we're looking at the markets and how this affects prices and things like that, people tend to think of the market as this machine or computer that's spitting out prices, but really the stock market is just a collective buying and selling, right, the trading from individuals like ourselves, maybe on behalf of an institution, on behalf of a fund, but it's humans buying and selling back and forth based on supply and demand. So these people are reviewing economic data, they're reviewing earnings data from different companies, they're using some math and computers and forecasting to decide what they think is a fair value based on their time frame, which again, we'll talk about time frames a little bit later in the call, right? But they're putting all that information in and they're deciding what they think is a fair value and buying and selling based on that information. So during, I'd say, a normal time going into February 19th, people had a pretty good idea of where they thought markets were headed, where they thought the economy was going. And now all of a sudden there's this big change, right? So this change is a surprise. People weren't planning for it and they react accordingly. There's also less certainty, right? So they don't know exactly what's going to happen. They don't know how people are going to react. So that causes a little fear in the market. So the reaction is a little bit emotional and markets start to sell and you see prices fall as a result of that. So that's where we find ourselves right now. If we look at what could happen as a result of these tariffs, that is really what's causing some of the selling pressure and some of the fear. The tariffs, as some of you may know, tariffs are a tax on imported goods. So anything that enters the United States now is going to be taxed. So it's going to increase the price of that good, right? Generally, companies don't just take that tariff and pay it themselves, they're going to increase the price of that good to help pay for the extra tax. So that means that us as consumers will now have to pay more for these imported goods. So that's bad. We've been dealing with inflation. Inflation means prices are going up. So if tariffs cause prices to go up, that's inflation, further inflation, which we've already been trying to mitigate for the past few years. So that's one fear, is that you could see inflation go up by as much as 1 to almost 2% if we were to see these tariffs stick around for the next 12 months. In addition to that is then what's the indirect effect, is that if prices go up, people might buy less. So demand goes down. So if demand is going down, that's an indicator into GDP growth, which is how we measure economic growth. So if you see economic growth start to decline or even contract, that's bad news, right? We don't want to see poor economic growth. That's usually an indicator of a recession or something like that. So that's scary. People start to sell based on that news. You could also see earnings projections start to get revised downwards, or companies actually, as a result of that decreased demand, start selling less as well. Those companies, if they're earning less money, if their revenue is declining, then you could see them start to lay people off, or right, that could be a worst case scenario, but that fear starts to enter the market, right? So all of those things, a slowdown in growth, an increase in inflation, those are all definitely bad, negative things that could happen as a result of the tariffs. So this big knee-jerk reaction is the market pricing in all of those bad case scenarios. From here, right, it's difficult when you see this sort of knee-jerk reaction. The market tends to sell first and ask questions later. So right now, the reaction is difficult to measure. It's difficult to say all of these events are priced in, and where's the bottom, when is the perfect opportunity. We'll never really know that. But what we do know is that the market becomes very headline driven. So positive headlines could cause upswings in the market. Negative headlines could cause further selling. So over the next couple of days, weeks, we could see some negative events that could cause some additional selling. For example, retaliatory tariffs. We've already seen some from China. I think we've seen some from the European Union today. That could continue. That could increase. We could see more countries start to react that way. Also, earnings season starts, right? Companies are going to start to report first quarter earnings. That starts this week. So if companies start to revise their earnings downward, I think Delta already removed forecasts from their earnings call, right? So if you start to see that information enter the earnings forecast for the year, that could be some negative news that causes some sell-offs. Also, if these tariffs stay in place long enough, you actually start to see the economic data reflect some of the things I talked about earlier with price increases and a decrease in demand. Because economic data and their reporting are backward looking and a little bit delayed, it's not live, right? When we get an inflation report, which I believe we should get this week, it's going to be based on what happened in March, and we're already almost halfway through April. So you won't actually see the effects of these tariffs hit economic numbers for a few months, but if the tariffs are in place long enough and nothing changes, right, those economic prints could have some bad news, which could cause further selling, right? On the flip side, there's some good news, right? I don't mean to be all doom and gloom. I just want to, be realistic about, there are some bad things that could happen as a result of these things, but there are some things that could move the market up. Big things would be any indication that there is progress being made on negotiations. If countries are coming to the United States, or United States is going to other countries, and they're indicating that they're open to negotiate their trade deals, possibly create even a free trade agreement, which I think there are discussions of that possibly with the UK, maybe some other countries, right? That would all be very positive news, and you could see the market react positively to that. So it's still very unknown, very headline driven, but that's really kind of what we're looking at from a market perspective at this point. Before we start talking about portfolio impacts and how we build markets, the one thing I want to kind of leave this market section of our presentation with is kind of what we see happening from here. And I'm not really in the business of predicting what's going to happen. I can't predict the future. Nobody can. So anyone who comes out saying that they know what's going to happen, that's a little scary. But I will tell you some of the things that help me sleep at night that I think are important to consider. The first thing is that all of the economists and investment professionals, the experts in the space, still believe that tariffs are being used as a negotiating tactic. The main reason for this is that nobody wins with these tariffs. Tariffs alone, as they stand today, do not help the United States solve any of their problems. The tax revenue we get from these additional tariffs do not solve our debt problem. So they aren't a solution to the problem that we're having. And if they remain in place, they cause a lot of additional problems, as I've already indicated here in the United States, but also the same problems in every country around the world. They're experiencing the exact same thing as a result of these tariffs, seeing price increases, demand go down, and that could be very bad for their economies and their companies and things like that. So those sort of big picture macro factors point to the fact that, we still believe that these tariffs will be used as a negotiating tactic. I'm not saying it'll be resolved immediately this week, next week. It could take weeks, could take even months. But again, I'm not in the business of trying to predict the future, but that's something that helps me sleep. In addition, I participated in a call on Monday with JP Morgan. Their chief investment strategist, Dr. David Kelly, gave a presentation. He's in charge of their investment direction for the whole firm, JP Morgan. And he started to discuss what could happen, if the tariffs, were to be permanent, and companies were to react and say, all right, these are permanent now, like, what do we do about it? And he gave the example of Nike and said, all right, so Nike's supply chain right now runs through China and a lot of other countries overseas. So what they would need to do is move their entire supply chain back domestically to the United States, building factories, hiring people, right? All of that information has to move back domestically to the United States. That's a huge capital commitment. It's going to take time. It doesn't seem realistic that would happen. And if you start to think like every company that has their supply chain somewhere else other than the United States is going to have to do that, it starts to seem more and more unrealistic that that's going to be what happens. I'm not saying it's not possible and can't happen or won't happen. All I'm saying is there's a lower probability. And the people running these companies stand to lose a lot of money as a result of that. So they're going to be lobbying to make a deal, whether it's lobbying their respective politicians in the United States, also their influence globally in the other countries, right? They're going to be lobbying for them to make a deal. So there's going to be a lot of outside influence from people who are much wealthier and much more powerful than myself, trying to get some sort of deal and move through this. So I think that that's good news. That helps me sleep at night. The last thing, if we look at, some more dire circumstances, if we aren't able to see any negotiations or any improvement made on the tariff conversation in the near future, the Federal Reserve also has the ability to cut rates from here. Current Fed funds rate is at 4.5%. In the pandemic, when we were looking to spur growth, the Fed cut interest rates all the way down to zero to help stimulate the economy and help spur some growth. So the Federal Reserve has a lot of room to cut interest rates to stimulate the economy and create some growth to help with some of those growth problems. So in a worst case scenario, that's also out there. So I'm not saying all of those things will happen or they'll happen soon, more just that all of those factors combined together, leaves me feeling positive. So from here, we'll talk a little bit about how this really affects portfolios and how we should be thinking. So if you look at some year-to-date performance, the S&P 500 probably right now down about 15% year-to-date. Since February 19th, down closer to 19-20%. Technology is really driving that downward, down over 20%. Consumer discretionary also in the same boat. Some of the sectors are doing well, relatively speaking, either flat or down only slightly. Consumer staples, utilities, healthcare, for example, aren't being hit nearly as hard just because of their the nature of those businesses. Really, the thing to think about, though, is our stock portfolio is our long-term portfolio. Our investments in the stock market are generally investments that we don't plan on touching or using for 7, 10, 20, maybe even 30 years from now. So when we're thinking about the current market conditions, as scary as it can seem and scary as it might feel, with the daily volatility and any indications that the selling pressure could continue in the next few days or weeks, with a long-term mindset, this really starts to look like an opportunity. So if you look here on this slide, you can see that in past bear markets, when we've gone through this before, you've seen the market rebound as much as 23% 3 months later, almost 30% 6 months later, 50% a year later. Your 3, 5, and 10-year returns all in double digits. So though the catalyst for these bear markets always changes and it is always different, 2000 we had the tech bubble burst, 2008 we had the great financial crisis, 2020 we had the pandemic, 2022 we had high inflation, right? All of these catalysts are always different, but how the market reacts follows a pattern. And that's why we always say, it's the 4 most dangerous words in investing are this time it's different, because this pattern tends to repeat itself when we enter these bear markets. So if you have a long-term mindset, this becomes an opportunity to take advantage of some of the numbers here on the screen. So the question is, how do we change our mindset? How do we start looking at our stocks portfolio as an opportunity? And the first thing to do is assess your risk tolerance. So on this slide, you can see you have a number of different risk tolerances here, and this largely points to the behavioral side of risk tolerance, how you feel about risk and your temperament. And while that is very, very important, and we'll touch on that a little bit later, the first part to risk tolerance is actually the math behind it, which comes from our financial planning process and a goal-based investment process. So we're looking at cash flow needs, how much money you're making, how much money you're saving, how much money you're spending. And we are doing what's called cash bucketing. So go to this next slide here. You can see that really the way we think about this is any money that you need from your portfolio in the next 3 years should be held in cash or cash-like securities. So if you're in retirement and you're pulling money from your portfolio to fund your lifestyle, pay your bills, any money that you're pulling from your portfolio would be in cash. If you have other big expenses in the next 3 years, maybe you're paying for a wedding, maybe you have college tuition coming up, a down payment on a house, for example, anything like that in the next 3 years, that money that you need is in cash. Cash is not going to fluctuate with the market. So if the market goes down 20% like we're in right now, you have the same amount of money. No big deal. You're not worried about it at all. And then for the next 4 to 7 years, say that's your intermediate term portfolio. So any money that you need 4 to 7 years from now, that money would be in the bond market. So again, everything I just talked about, if any of those events fall in the next 4 to 7 years, that money is going into the bond market. You have significantly less volatility in the bond market, though you are able to earn a little interest on those investments. So you have a little bit room to gain there. Have a little volatility as things move around, but significantly less in the stock market. The other good thing about the bond market is that it's going to be what we say negatively correlated to the stock market. So in this environment, for example, stocks are going down, people are selling risk, they're buying safety, they're buying bonds. Bond prices are actually going up right now. So this portfolio that I talked about, your short and intermediate term portfolio, all the money you've set aside for goals for the next 7 years has actually grown since February 19th. You have more money for your goals in the next 7 years than you did at the start of this bear market. So that's great news. So then if you take that and you say any money that you don't need for the next 7, 10, 20, 30 years goes into the stock market, now you've become a long-term investor. Now your mindset has changed, and now you're looking at this volatility as an opportunity. And now you're thinking about, all right, how do I make decisions? How do I take advantage of this? More importantly, you're not thinking about selling. Worst thing that we can do in a bear market is sell. That's the only way to lock in a loss in a down market, is to sell in it. The best thing to do is ride it out. And if we go to this next slide here, we have some evidence of that. What you can see here is if you're continually invested, you earn around 10% a year. This is 20-year data on the S&P 500. So your average annual return over the last 20 years has been close to 10. If you miss the 5 best trading days over that 20-year period, so not 5 per year, 5 total over 20 years, your average annual return drops to 7%. If you miss 25 of the best days, you're less than 2%. You're less than inflation, right? So that's the risk. So if your portfolio is not allocated correctly and your buckets aren't set up, you might be inclined to start selling in these markets rather than trying to take advantage of them. And what we've seen is that the best days in the market follow the worst days in the market. I think it's 86% of the best days fall within 8 days of the worst days. I know I said days a lot there, but I hope you followed me. So Thursday, Friday of last week were the worst trading days we've had since the pandemic, back-to-back days. History tells us that one of the best days should follow in the next 8 to 10 business days from there. Again, I'm not predicting the future. I'm not saying this will happen. What happened in the past is no guarantee of future results, right? But that's what the data is telling us, and why we build portfolios this way, so we don't set ourselves up to make those mistakes and miss these best days and hurt our performance long term. Now we can talk about aligning your financial strategy, and we can pass it over to Katie.
Thank you, Nick. Tons of really great information, and a lot of it is digestible, and a lot of it you're probably asking, well, how does this apply to me, right? So we're going to talk a little bit about what you should be looking at for your own situation, and some questions to ask, and go from there. So really, when we think about asset allocation, which is what Nick was talking about, where we as financial planners come in working with our clients is say, we want to make sure that you have a safe place to access cash when you need it. So like Nick was mentioning, what are the big things that are coming up? What are your regular expenses? And how do we make sure that you have enough cash or cash-like investments in there? That's the first step, right? But the second piece, and the hard part about executing that strategy, is the cash in the appropriate tax bucket. So you don't only have, if you have cash, it might be in your 401k and not maybe in a non-IRA or non-401k account for you to have access to. So you have to start asking questions like, is the cash in the 401k accessible to me? Maybe I'm pre-59 and a half, and that doesn't make sense for me to pull from because I'll get a penalty. Or is the cash in my IRA, but I don't want to pull from that right now because I don't want to increase my taxable income this year. Or maybe you have some cash in your Roth IRA, but really we want that strategy to be executed to grow tax-free long-term and for life and for the next generation. So when we look at an asset allocation and this stock, bond, cash alternatives portfolio, what we want to do is make sure that's overlaying with whatever your personal financial goals are in line with asset allocation. Next slide, please, Nick. So that's where financial planning comes in. And folks like yourself might already be working with a financial planner. So some of this should be refreshing or a refresher, and you can call and ask them about this as well. But if you need assistance with that, we're also here to help. So the big purpose of financial planning is, do you know if you will run out of money before you run out of life, right? So part of that process is, first and foremost, you're going to look at your current finances. Say, how much am I spending? How much am I saving? What am I going to need? So that's all part of that cash bucketing piece that we were talking about. Then we have to look at what's important to you and what's most important to make this successful. So that comes into protection and protecting the things we can't afford to lose, like income, insurances, things like that. And then we get to accumulating wealth. So the goal is, over time, we're going to build wealth, accumulate that, and then set up a strategy to make sure that's the most tax advantaged strategy that you can execute. Then from there, we're planning for retirement, whether you're in retirement or pre-retired. We want to make sure that you're able to do have the life you want to live in retirement and even before retirement, right? And then from there, we're thinking about legacy goals, preserving wealth, et cetera, to make sure that If a legacy is important, you can live that legacy in your lifetime, or you can pass a legacy on to family, friends, charities, whatever you feel most passionate about. Next slide, please, Nick. So in volatile markets, in what's going on today, here are some of the things that we want to make sure you're asking yourself now, so that you can be prepared now and then in future volatility as well, which is, what's an appropriate cash reserve for me? Is my tax strategy diversified? Do I have a target retirement date? And then what's the plan to get there, right? Do I have a plan to ensure I won't run out of money before I run out of life? Does my investment strategy reflect my values? Have I stress test my goals through alternate situations? I just want to highlight this a little bit. So most financial planners, or what we do here, is work through a Monte Carlo simulation, which it's over 700 potential scenarios. And one of the scenarios is what we're experiencing today. What if the market drops 10, 20, 30, 40%? What's going to happen to my plan? Can I still do all the things I've worked so hard to get to, right? So that's what we're doing with our clients, is making sure that the plan is still set, you're still okay, and running it through that scenario to say, okay, now that this happened, what does this mean for me? And that's really the big question we want to answer. So that is that stress test question there. Have I reassessed my risk tolerance? So Nick talked a lot about risk tolerance. A lot of people are very aggressive when the market's up, and then you see people's true risk tolerance when you go through some of this volatility. So really taking a look at, what's my risk tolerance, and am I okay with all this? And have I spoken about any of this to my financial advisor? And do they listen to my concerns, questions, fears, anxieties, right? And then how do I create a retirement paycheck? So all of those questions are really great questions to ask yourself. If you're working with someone and you can ask them those questions and help work through that with you, that's incredible. And if you need someone to ask those questions to, we're here to help and help you work through that. So overall, our goal is to provide that peace of mind around your finances, and getting answers to some of these questions can help you work through that. So Nick, if you want to go to the next slide. Really, I want to end this with an offer to help. As I started the presentation, I said our goal is to provide confidence, simplicity, and success when it comes to your finances. And when markets fluctuates, that's where we shine with our clients, is making sure that we can help you manage the volatility and take advantage of some of the strategies involved in the market volatility. So our goal is to be focused on you and your goals. And if you're feeling uncertain and you want to discuss any of that, that QR code is your ticket to do so. Heidi, my friend Heidi, also just put in the chat a clickable link for that. So you can request a consultation. We can set up a time to chat about your goals and making sure that you're protected in volatile times. So with that being said, the Q&A is open, and Nick's come back on the stage so we can answer any questions. If you have questions that you want answered today, feel free to throw those in the Q&A. And we will go from there. But thank you, everyone, very much for your time. Nick, I'll start with one question here. What do you tell clients that want to change their allocation now?
That's a great question. So as you just mentioned, right, these volatile markets are usually the first indication that maybe their risk tolerance isn't what they thought it was when we're going through a bull market. So we tend to think about selling and getting a little bit more conservative to stop some of the losses in our portfolio. Generally, what I would say is now is not a great time to be changing our risk tolerance necessarily and becoming more conservative. However, rebalancing your portfolio is a great way to help in these scenarios and just bring your portfolio back to target. So this is what we're doing in our discretionary models and the clients that we're running for the portfolios that we're running for our clients. So what this just means is you have a model, a target portfolio of, let's just say 60% stocks, 40% bonds. They may have drifted right now, right? Stock prices fall so dramatically. Maybe that's now looking at 50-50, right? So what that means is, if we rebalance, we sell some of the growth we're seeing in the bond market, and we're buying some of the stocks that are now at a discount. And then when you do see the market rebound, if we think back to that slide I had in how the market looks 3, 6 months, 12 months from now, that slight little change in your portfolio helps you really take advantage of those prices and enhance your performance when the market does inevitably bounce back.
Awesome. Thank you. Yeah, I think, and what I hear from you is having a plan beforehand and knowing that you're in the right allocation is going to be huge.
Yes, exactly.
Awesome. Okay, this is a good one. How could recent events affect the dollar? Will it remain strong?
That's a great question. So I don't want to get too technical with how currencies work, but currencies are really dependent on interest rates. Because the reason people are buying and selling different currencies is to take advantage of investments in those respective countries. So if you were living in, let's say, Japan, right? You can invest there. I think their interest rates are close to zero. So if you go to the bank and invest your money there, you're going to earn almost nothing on your investment. However, if you take that money and you buy dollars and then you invest those dollars in a U.S. bank, our Fed funds rate's at 4.5%. So that's great. So people would buy up U.S. dollars with their Japanese yen and invest in the dollar, right, and bid it up. So as you look at how interest rates change between the United States and other countries, that is really the fluctuations in the US dollar. So as long as our interest rates remain high versus other countries, I would expect the dollar to remain fairly strong. However, if you do see the Fed start to reduce interest rates, to become more accommodative to our economy, you could see the value of the dollar decline. So that's how I would expect it to react from here. Generally speaking, I think any currency will not increase against a basket of all other currencies upwards and forever. They're usually pretty range bound and fluctuate back and forth. So it's not something we typically invest in or don't invest in. We kind of play middle of the road. But yeah, that's what I would expect from here.
Thank you. All right, this is a good one to end on. And you mentioned this a little bit. Oh, I just got one more. So we have 2 more questions. We'll start with this one. This is from Cynthia. You touched base on strategies for those in their 60s or near retirement or actually retired. Anything further to manage fears of the future and drops in the market?
This is a good question. So if we're talking about managing fears for the future, really I would take it back to your financial plan and take it back to your goals, right? And look at how much money you expect to need from your portfolio in the near term, in the intermediate term, and in the long term. And then look at how those specific pieces of your portfolio are performing and confirming that your portfolio is aligned with those goals. Because as I alluded to, your stock and bond portfolios are actually increasing in value right now. So, a 7-year timeline, if we think about what's going to happen between now and 7 years from now, a lot can change, and a lot of this near-term volatility will probably be behind us by then. So I think if we're talking about easing our fears in the future and future drops in the market, I would really focus on what you do need in the near term and aligning your portfolio with those goals.
Yeah, and Nick, one more thing I'll add is, there's a lot of publications coming out right now and different charts and such. Nick and I were talking about this morning about how many different charts we have in our email about market volatility. But one of the ones that we've looked at is it shows, over the history of the market and the S&P 500, every 4 years, every 1 in 4 years, the market ends down, right? So that means every 3 and 4 years, the market ends up. So I think it's always a matter of, we don't know why or when exactly, but we know market volatility will happen. And there's always a different reason why, right? In 2020, it was COVID. There's always a different reason why. It's just a matter of, we can't know exactly when. So how do we prepare? Because we know there is certainty in uncertainty. So I think that's really important to think about when you're thinking about your financial plan, your goals, and your risk tolerance there, because it's just managing the volatility and how we can react to it. Which actually leads perfectly into our last question, Nick, which is, you mentioned this a little bit in your presentation of the words, "this time feels different." So how do you respond to clients when they say, "this time feels different"?
Yeah, this is, one of my most popular questions, or most popular concerns. And I go back to every bear market we had really since the Great Depression, right? Every bear market, every recession, every correction has been caused by something different. So in that sense, we are always different. But if we tie it back to what I started the call with, is that the pattern that follows is always very similar. And the market itself is very behavioral, because it is just a market of human beings, right? So we can be emotional. We have our certain tendencies when we see some fear in the market, and that is generally to sell risk and buy security, buy safety. So that pattern persists. So that's exactly what we're seeing right now. It's what we've seen in the last X amount of bear markets, right? This is our third in 5 years. The pattern has all been the same. We've seen the stock market decline, risky securities have sold off. People have turned to things like treasuries and bonds and other things like that for safety, and those prices have gone up. So those cycles, those economic cycles, market cycles do repeat themselves. It's just the catalyst that changes. So the catalyst is always scary. That's where you get into that negative news loop, right, about what the new catalyst is. But there's always something. There's always something out there, always something that's going to cause a little fear. How the market reacts will always be fairly similar. And that's what we're seeing right now, which is what gives me confidence that we'll get through this. And hopefully we'll be looking back a year from now and it'll be just another bear market.
Thanks, Nick. All right, with that, that'll wrap up our Q&A section. As always, if you'd like to personalize the conversation, like I mentioned, there's that QR code. You can just fill out some information and we'll be in touch. Also, the links in the chat as well. But with that, I'd like to thank you all for joining us today and pass it back to Ernesto to close us out.
Thank you very much, Katie and Nick. Wonderful presentation, and I think some comfort and good decision-making tools there for certainly volatile times. Once again, I'm Ernesto Burden. I'm the publisher of New Hampshire Business Review. Thank you to everyone today who attended, and thank you to Rise Private Wealth Management who sponsored today's webinar. Katie, Nick, great job. Everybody, have a wonderful rest of the day. Thank you so much.
Bye, everyone.
Bye.